Hey everyone, Couch Investor back to another video for today. So let's talk about DocuSign. The company reported earnings last week. Stock was up 12% the next day. It is though still down over 60% year to date, but the stock was up because, well, the market saw some improvements in the company. As you know, new management, new CEO usually takes a little bit of time until things get a little bit better. They obviously laid off, I think it was 7% or so of the workforce a couple of months back. You will see that in this quarter as well. But in my opinion, they still have, I think, over 7,000 employees. And for a company like DocuSign, whether you like it or not, 7,000 employees is a bit much. Now, again, this was an okay quarter. Market liked it. Outlook was also fine, high single-digit growth. Don't expect hyper growth for DocuSign probably until they come out with something new, or maybe they'll acquire a company, or maybe they will get acquired because they are worth around, just under $10 billion in market cap. Stock price is just under $50 right now, just under $10 billion in market cap. Could be a good acquisition target. Now, I did cover the company previously, and I'll say the same thing I said before. I do like the product. I do like what they're doing. Yes, they're dominating in the e-signature business. Yes, they're saying there is a $50 billion total addressable market that they're going after. E-signature and then just, well, the agreement cloud, CLM, etc. And then more evolution in those markets. But right now, they are just taking $2.1 billion of that total addressable market. Now, I'm going to have to say that right now DocuSign does feel like just a feature that a large company can come out with and just destroy DocuSign. Now, of course, a feature is easy to make. What's not easy to replicate is, well, all the data that they're collecting, all the automations, all the clients, all the ecosystem that they've built around one of their products, and then you can adopt multiple products as well, which is why I believe it's probably hard for customers to leave DocuSign for other companies, for example, like Adobe. But it is something to keep in mind. And now, while DocuSign is still free cash flow positive, has been like this for quite a while, it has come down, well, tremendously quarter over quarter, but year over year as well. And if we go and look at the expenses, stock-based compensation, that has actually been increasing, so not that great. Now, if we're purely looking at valuations such as price to sales ratio in the next 12 months, it's under 4 times. If we look at gross profit, that's just over 5 times. That's in the last 12 months. Now, EV to sales, same thing here, 3.7 times next 12 months or 4 times in the last 12 months. Now, of course, if you look at PE ratios in the next 12 months, you're still extremely high there, 23.8 times. For a company that is probably not growing that fast, it's still high. So now, before we go and have a look at the earnings report, if you enjoy this type of videos, leave it a thumbs up and subscribe if you have not. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Make sure to check out all the other links in the pinned comment as well. So this is basically what they're viewing as their goal, a approximate $50 billion in total addressable market. There is a $25 billion market in the e-signature business where they are the number one there. And then there is another $25 billion market in the e-signature add-ons plus CLM. Now, with regards to CLM, this is something that, well, the new CEO will be pushing more and more.
I talked a little about the roadmap. We think we can go significantly broader. If you think about agreements, what we did was we automated essentially the signing of existing forms. But when things move to digital, that's not usually where things stop. All aspects of agreements, developing them, negotiating them, agreeing on them, and then managing them, I think are ripe for improvement, and we intend to focus on that.
Of course, CLM is nothing new. The previous management has talked about that as well. But of course, coming out of the pandemic, seeing that spike during the pandemic, maybe the focus wasn't there. Now, coming out of the pandemic into the weird macroeconomic environment, some things need to change, some growth. Well, growth has to come from somewhere, and he believes, I do believe as well, that it can and it probably will come from that CLM part and maybe a bit less from the e-signature. And don't forget, they can still acquire other little companies that can contribute to the overall business as they've done in the past. So in this quarter, revenue grew 18% to $645 million, beating estimates by around 18 million or so. Subscription revenue is 97% of the revenue contribution. No surprises there. Now with billings, this is where things get a bit more, not tricky, but this is where the risk lies probably. As you can see here, it has basically been flat for a couple of quarters now, and then the, let's say, turquoise line here is the rolling 4Q year over year, has come down each and every quarter. But if we look at the customer base, especially also enterprise and the commercial customers, that is still growing. Of course, they give us this example of fiscal year 13 to right now. Total customers have grown 39% CAGR. And when it comes to enterprise and commercial customer, that has grown 50% on CAGR basis. So, okay, great growth there. And if we look at the cohorts and the net retention, it's 108%, which is okay. It's over 100%. That's fine. But also, by the way, the customers with over $300,000 in annual contract value has increased as well, 44% CAGR from fiscal year 13 to last quarter. But going back to the net retention rate, as you can see right here, this is what happens when you, have huge and accelerated growth in a short period of time. And then after that, we go into a more difficult environment. And this is what happens. Q1 fiscal year 2022, 125% dollar net retention. Now that has dropped to just 108%. If it goes under 100%, there's clearly something wrong. Now, another tactic or another reason why this quarter performed better than expected is because of international growth. And this is, again, something that they will keep on doing. And it's probably an opportunity going forward. If you're looking for growth, why not try the international markets? So 23% year over year revenue growth internationally, and that's 24% of the total revenue. And now the expenses, as you can imagine, it has been increasing year over year, but as a percentage of revenue, it has always stayed around that 40%. Although if you ask me, it's still quite a large number. 41% in sales and marketing here for a company that is now not growing that much anymore is a bit much. And it probably reflects on, the operating income, operating cash flow, and free cash flow. It has been coming down. Now with non-GAAP operating income, that's now at 23%, which is higher than last year. Fine. And I believe for Q4, it's also going to be around 4% higher as well. So great on that. But if you look at operating cash flow and free cash flow, we went from 19 and 17% to 8 and 6%. Now with regards to Q4 guidance, there is a little bit of growth. Not that much. They're seeing non-GAAP operating margin to be, to come in between 20 to 22%. Their long-term goal is between 20 to 25%. Let's see what happens because, for the fiscal year 2023 guidance, the non-GAAP operating margin sits at 18 to 20%. The CEO did say that they're still convinced they can reach that goal of between 20 to 25%. And in 2023, the year, but fiscal year 2024, that should remain unchanged. So overall, look, I don't hold the shares anymore. I do still like the company, but I would stay on the sideline right now to see what happens in the coming quarters, to see if they're making any interesting moves in any direction, maybe acquiring some little company, maybe suddenly announcing something great with regards to CLM. Let's wait and see. Let's see if they can keep up with those margins. Again, stay on the sidelines if you want. If you have a position already, if you want a dollar cost average, that's your plan, maybe do so. It's your position. But overall, these are my thoughts for this quarter. Let's see what happens in the coming quarters. That's all I can say. Now, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Obviously, do share your thoughts down in the comments below. And I'll see you all in the next one. Bye-bye.